Yeah, great. All right. Hi, everybody. Welcome to How to Build a Powerful Scalping Strategy. My name's Tom, and as always, I'm here with Tyrone.
Hello, everyone, and welcome to the Scalping Strategy Night. It's going to be a lot of fun.
Yeah, we're looking forward to doing the next couple of webinars. So if you like tonight's one, I definitely suggest you attend the next ones as well. So what we're going to be covering tonight, well, firstly, I guess we'll do the risk warning. Just the information provided here has been produced by third parties and does not reflect the opinion of Pepperstone, and the information has been provided without any alteration or verification. So I'll just leave this up for a couple of seconds for everyone to read over, and then we'll get started. Okay, so what we'll be covering today. So we're going to be covering how to become successful in scalping. We're going to be taking a look at different types of scalping strategies and how to follow a rules-based approach. Probably the most important thing in trading, following your own rules. Many of us can attest to that. One late night, you're sitting up and you're trading, and then all of a sudden, you know, the rules go out the door and you've got 5 trades open. So we've all been there, we've all done it, but following rules and trading like a business, and Tyrone and I can't continuously tell people that you need to treat trading like a business enough, because everybody breaks their own rules, and it's probably one of the biggest things that leads to unsuccessful trading. And we'll also be covering how to lower your trading risks when using a scalping strategy. So a little bit of risk management discussion, and also it is about following your rules. So we'll be talking about that. And then at the end, we've got a Q&A. So we'll answer some of the questions you guys are asking, and Josh is going to get a couple of those questions. So if you ever have a question during this webinar, please ask away and we'll answer it at the end. I'd also, just want to cover a couple of steps, or 5 steps to become successful in scalping before we get into the charts. So the first one is we need to pick specific currencies and times to trade. One thing about scalping that's different to just trend-based systems or anything else is you are trading smaller time frames. So you need to be kind of like a specialist at those currencies. So what I mean by that is that if you're going to be trading, let's say the euro US dollar or pound US dollar, they're both US dollar pairs, and therefore they will trade similarly. And you'll end up using maybe the US dollar index as well to help you with that scalping strategy. The one other thing about that is if we're now trading Swiss pairs or Japanese pairs, yen pairs, they're going to act differently because we've got different times of the day that they're going to be more active. So, of course, Japanese pairs are going to be more active during the Asian session, and euro and pound pairs are going to be more active during the London session and US sessions. So we need to be very, very careful of what currencies we're picking. And I always suggest with scalping, become a specialist at maybe 3 to 5. What do you think about that, Tyrone? About 3 to 5 pairs usually?
3 to 5 pairs is a good number to start with, especially when you first begin. But I think, as Thomas alluded to, picking your particular time frame when you are trading is really, really important. So just have a very good understanding as to which market is open at the time that you're doing your scalping trading, because again, we are only trading very short amounts of time. So just be very mindful that the pairs that you are trading are going to react very differently in a New York market versus an Asian market. So just having a very good understanding of that is quite important to become successful at scalping.
Yes, and one thing we noticed is, and I'm sure a lot of you know, when I guess the bell starts, like in the stock market, or when their sessions first open, there's often a lot of activity and generally a bit of economic news around that first hour to 2 hours. So if you are scalping, economic news is not necessarily the thing you want to be seeing. You want to see more of a technical market, because you're looking for technical entries where you're going to be able to predict at a high percentage where the market's moving. So you've got to think about that. And sometimes taking trades at the beginning of a trading session is not always ideal for a scalping strategy. We actually found when we were scalping very heavily many years ago that the back end of the US session was pretty good, because the market really tapered off. All the news had settled for the day, and you found that markets became more range bound. So a lot of the points-based systems we'll be talking about tonight worked quite well during that time.
Yeah, the last little bit of New York is unique in that it's the only market in the world that is actually open for those last 3 or 4 hours. So
everyone else is sleeping.
Everybody else is sleeping. But more importantly, you haven't got different central banks working against each other to try to assume control.
Mm-hmm.
So when the New York as it is with everything in the world, when America's in charge, which they like it, the New York Stock Exchange and currency markets move very, very smoothly. So it's a very nice time to trade if you can stay up that late.
I can't remember the statistic, but there used to be a statistic where London would push a market a certain way, the Asian London session, and then the US session would reverse it to about 60% of the reverse. That used to be actually a statistic in trading.
For a while there was a trading.
It really was a war. Yeah. It really was a war. Anyway, nowadays, obviously, with this 24/7 news, it's a little bit different. But we do suggest that you pick your times and then you focus on those times and become a specialist.
Just as importantly, recognizing a trending or range-bound market is one of the steps that you really have to pay attention to. Scalping is not all about counter trending. A lot of people think that you have to counter trend to actually scalp. That is actually not always the case. When you're trading a range-bound market, you can trade long and short in a channel, or potentially an ascending or descending channel. But when you do recognize a trending market, it still gives you the ability to scalp. But it's always advantageous to be scalping in the direction of the prevailing trend, of course. So understanding which market you're in is very important.
Then, of course, multi-timeframe analysis. No matter how low a time frame you're looking at scalping, whether it even be a 5-minute or 15-minute, we always suggest just take a quick look at the daily, take a quick look at that trend, as Tyrone was saying. And when you know that, it can give you a slight bias. And even if you're trading the 15-minute, 5-minute in the direction of that daily trend or that overall bias, you will find often they'll be the more aggressive moves. And of course, that will mean your scalp is in and out quicker, which is the whole idea, less risk to economic news and other things.
Sticking and following your trading system rules.
I think we discussed that. We'll get going into
that. We have discussed it. It is very important. We're just going to basically brush over it now. But look, the thing is, everybody starts out scalping when they first start trading because it is exciting, and you just have to be mindful that you need to really follow your rules to make sure that you don't get yourself caught up with too many trades open. And it leads on to the next step, really, ability to manage your trades. You really need to understand, which market you're trading, and not just seeing opportunities and going willy-nilly before you know it, you'll have 10 trades open, and 7 or 8 of them might be all correlated to each other, and then all of a sudden, you might be risking 1% per trade, but actually you're risking 7 or 8% per trade just through no diversification. So rules are important, and managing trades basically falls into that category as well. So just stick to the rules, and scalping can be fun and also very, very effective.
And remember, not every day has to be a day you take trades. There are some days where there really is not any good trades for your particular currencies that you've picked. So let's take a look at the actual market right now. We've picked out a couple of things in the market that we're just looking at, and we want to go through one of those first. So here we've got the Australian US dollar. So actually what I want to do is focus on the euro. So we'll focus on that first, and we're on the 15-minute chart. So obviously a very good scalping chart, 15-minute, 30-minute, 1 hour, 5-minute, all pretty good scalping charts. They're the kind of ones where you're in a trade maybe for only a couple of hours and then you're out. At maximum, you'd be looking at maybe an 8-hour trade with these kind of timeframes generally. When you go to 4-hour daily, obviously you could be expecting days, or at least a few days potentially in the trades. So our aim is to be in and out of these kind of trades quickly. And here, what we can see is we can kind of see a little bit of consolidation in the euro. So if we're just doing some basic strategy and we look at even just a line chart, what we can see is there's been some resistance at this point. And if some people out there don't know what resistance and support is, I highly suggest that you do some work on your resistance support, because it does underpin a lot of successful trading strategies. And then we can also see there's been some support down here at the lows at 122. So a few people are probably saying, oh, well, that looks like a channel, and they'd be right. It's basically a range-bound market at the moment. So we've had a market where there's been a sell-off in the euro. It looks like it's been, for a little while on this time frame. And what we would do is we generally just take a quick look at the daily and see what's going on. So overall, the trend has been up. But of course, now we're seeing a bit of consolidation, and this looks kind of like a double top, which is another strategy that you can look at on the longer timeframes. But what we're interested in is we're interested in this 15-minute chart. So a bit of a sell-off, consolidation. What we then need to do is we need to say, okay, well, this market is range bound. What kind of strategies could we use to potentially make some money here using scalping?
So the thing with a range bound market is one of the biggest keys to it is actually not trying to predict when it's going to break. The market's going to do what the market's going to do. So the best way to play the market is to actually trade what it is showing you. So while it is channeling, as we can see, it's been channeling for the best part of 4 days now, really in this zone on the 15-minute chart. It would be, I guess, foolish of us to be trying to predict a break when there's so many trading opportunities inside that channel. So until the market actually does break and shows us that it's time to either go long or short, we need to play to the strengths of what the market is actually showing us. Now, to do that, we're going to start adding a couple of indicators that really complement a scalping strategy, especially in a sideways market. There are particular indicators that work very, very well in sideways markets, and one of those is stochastic, which I'm sure many of you have heard of. It is one of the most popular indicators going around, and it is essentially a momentum-based indicator, which basically derives its signals from measuring the current price to the highs and the lows of a predefined period, which is generally 14 on the stochastic. Okay, here we've also added a Bollinger Band, a 2 standard deviation Bollinger Band, which is quite nice because it does actually interact with price very, very well in a range-bound market. Now, the thing about, for people who don't really understand how Bollinger Bands work, the middle band is actually, as a default, a 20 moving average. Okay, so if you've ever got a 20 moving average on your screen and you load a Bollinger Band on, 9 times out of 10, it will completely cover the 20 moving average because it's effectively the same thing. And the upper and the lower bands are basically 2 standard deviations away from where price would be at its mean, which is the 20 moving average. So the trick to using a Bollinger Band is actually keeping it at a 2 standard deviation in a sideways market, but changing the deviations out in a trending market. So if we're going to look at trending markets a little bit later, and I'll show you an example of what I mean, but in a heavy trending market, it's actually ideal to take the standard deviations out to maybe 2.5, sometimes in extreme trends, maybe 3, just so you don't get too many false signals. Because what the Bollinger Band does, it expands as the volatility and price increases. So if the Bollinger Bands are too tight, what you'll see is it pushing one band as it trends, and it doesn't really give you any meaningful signals. So in a sideways market, a 2 standard deviation is very beneficial. And as you can see right through this 15-minute, 4 or 5 day period, the Bollinger Bands are basically containing nearly all of the price, and it's basically bouncing from one end to the other. Now, do we trade Bollinger Bands in isolation with no other evidence? Absolutely not. And that's going to lead us on to our rules-based system a little bit later on. But it is certainly one of the things that we will look at when we're looking for an entry point or an exit point.
So the reason why we bring up Bollinger Bands, we bring up stochastic straight away, is you're probably seeing, I put this line here, this vertical line, and what you can see is there was a heavy sell-off, and funnily enough, the market hit our resistance point, and it actually closed above our Bollinger Band deviation up here. So when that happened and it hit our resistance, we want to be looking for other reasons potentially to short this market, because we know it's a range-bound market at this point. So you can see here, here's the stochastic. The stochastic is in the overbought, and then it starts to turn at the same point as we see this particular break happening here. So we've got a couple of reasons to say the market may be at resistance, and therefore we can benefit from shorting it at this point. And then, of course, profiting from the decrease in price. And we even have our potential take profit here, because when we're seeing these things all coming together at once, we know that it probably most likely will come back down to the support level down here. So that's the beauty of channels, especially on the scalping strategies. When you recognize it breaking the Bollinger, it breaking past the overbought or oversold on the stochastic, and we'll add another one later, you can basically say, okay, this statistically should be more likely to sell off than it is to go up at this point. And when you get statistics in your favor, obviously that means that you've got an opportunity to make money from scalping. And in this case, your stop would not have to be very big either, because if we were selling up here, let's say we sold here when it broke past the Bollinger, our stop would really only need to be pretty much above the last kind of wicks over here. So in scalping, you always look for the last time the market's told you something. Market over here said, well, it has gone up to this point before, so this would be a 13 pip stop. What we would do is we would place the stop loss a little bit above that to give it a bit of room, probably give it around maybe 20. Here it's 18, so we might give it 20. and our potential take profit would be all the way at the bottom, which in this case is 60. So that's pretty good. That's a 3-to-1. That's not bad in risk reward. And that's the beauty of scalping. Sometimes you can get these things. So if you risk 1% on this trade, you could potentially make 3%. And you can see it's happened again over here. The Bollinger's broken out of the standard deviation and it's hit our resistance. And the reason I moved from a line chart to a candle chart is because you can see it just tapped that point. And the reason I picked this point on support resistance is because that's where the most of the bodies closed. This was really, you can even see here there was a rejection. So this was really an outlier and all of the bodies were closing here. So this was the most likely point for it to find resistance. So we're using the stochastic, the Bollinger, and support resistance together to build a story which we can use for a rules-based approach. If we then add some other indicators, we can even add things like MACD, which is obviously a very, very popular, indicator. Tyrone, do you want to talk about that quickly?
Sure. So for those who are not familiar with MACD, basically the MACD histogram measures the difference between two moving averages on the chart. So your standard setting on most platforms for MACD is 12 and 26. And the 12 and 26 represent two moving averages. So if we were to actually, if we had two moving averages on the chart, they would represent, the histogram that we see here represents the distance between those two moving averages. So what we're seeing here, even if we have a look at this very last break that Thomas is talking about of the Bollinger Band, we've got effectively what looks like a potential double top at resistance outside of a Bollinger Band. But just as importantly, what we've also got is a lot lower peak on the MACD indicator. Mm-hmm. So just building on what I've just explained, what this is showing us is that the gap between the 12 and the 26 moving average is a lot smaller here at this point than it was here, which is telling us that the price is starting to lose momentum. It's not going up with the same force that it was at this point here. So that really signals that there's a potential reversal, in play, aside from the fact that we're at another resistance point because of all of the other touches and the fact that stochastic went into the overbought and we've got a break of the Bollinger Band. We've got another reason, which is actually derived from a completely different source, because MACD uses primarily moving averages to give us its signal, whereas the stochastic uses momentum and Bollinger Band uses volatility. We've got three very significant indicators there saying that price doesn't look like it could go much further.
So you can see multiple things coming together to prove a case. Effectively, that is trading. One thing by itself usually doesn't work. It's multiple things. Even someone as successful as somebody like Warren Buffett, he uses obviously a value-based approach in stock, but he uses multiple reasons to get into that stock position or to place that trade. So the most successful traders of all time, whether it be a Soros, whether it be anybody, they always do it by making decisions based on more than one piece of information. And what I find a lot of newer traders do is they get enamored with maybe something like a hammer or a shooting star candle or a pin bar or whatever they want to call it. And then they just look for those and they treat it like that is a 75 or 80% system. And it's just not by itself. You need multiple reasons so that other traders are also trading those systems with you. And that's what you want. The biggest guys trading in Forex, because it's a big traders game, you need them trading with you.
And the problem with not using the evidence and rules-based approach is that if you get fixated on potentially a Bollinger Band breach, at some point Bollinger Bands are going to continue up. They're not holding the market in a certain position. Now, if we had a look at this example again and we looked at the MACD, and let's just say that the MACD peak was up here instead of down here, yet we still had a Bollinger breach, this trade wouldn't look as strong, because what that's telling us is that the fast moving average, being the 12, is accelerating away quicker from the 26, which means that the market has a lot of momentum at this very point. So although the Bollinger Band is indicating that it is outside its standard two standard deviations of its price, the MACD indicator is giving us a completely different signal, saying that the momentum is actually increasing. So that's why it's really good to overlay different indicators that actually complement each other, but actually derive their signals from very different sources to verify what we're trying to achieve.
So let's just jump back into the slides quickly and take a look at a couple of market conditions that we can recognize. So let's recognize some market conditions. So one thing, obviously channeling markets, really big on scalping. I find especially if you pick your sessions, like we were saying before, if you pick the back end of the US session, then you will actually have more success in the channel market generally because that particular session is slower. Only the US up, usually they're only trading. So it's a little bit slower, a little bit smaller moves, but more channeling markets. Once we've recognized channeling market, we can definitely implement those kind of rules that we discussed as well. Then you've got things like double tops, double bottoms. They're good for trend reversals, maybe not so much for scalps, but they are important for us to recognize on the larger time frame. So then we can go down and we have a bias for our scalping based system.
And what you will find is that double tops and double bottoms are synonymous with channeling markets because they do signal the resistance and support zone. So they do complement each other quite nicely.
Yeah, they do indeed. And then, of course, we've got trending markets. So we're going to be taking a look at a trending market at the moment, and we'll look at a trend line and how we can build that into our strategy as well. So I just wanted to quickly go through a channel break example as well, because we've been talking about the range bound part of a channel. But then if it does break, we need to potentially be able to profit from that break. As Tyrone said before, we don't make the decisions on what the market's going to do. We read what the market is doing and make the decisions after it has confirmed to us that something's happening. So here we've got a channel break. We've obviously got that range bound market similar to the euro US dollar at the moment. Now, what we'd be looking for is if it did break above, we'd be looking for a buy. And if it did break below, we'd be looking for a sell. And of course, then we could place our stop loss level. This is the conservative stop loss. You can place it below the last swing. And we'd be looking for the distance of the channel to that particular direction. So in this case, the channel distance was here. Let's say that was 100 pips. This distance would also be 100 pips. So I just want to show this to you because in scalping, there's a lot of different market conditions that you can find. We are going to focus on that range bound style, but if a range bound is broken, this is often what happens, and that is also something you can take advantage of. So never have too much bias that you're not prepared to get involved with a directional change. You always should be risking an amount of money that you're comfortable with, and therefore you can chop and change a bit. And in currency, as you know, things go up, things go down, things do move all around, and there's always a changing fair value for currencies. So we need to be very biased towards nothing really, and basically picking what the market's telling us.
Yeah, scalping is really trading what you see. You can't go in there with too many preconceived ideas of what the market is going to do, because simply you haven't got the time to basically play the waiting game, because then all of a sudden you're not scalping. Now, one of the common questions we get asked a lot is how many pips can you actually get in a scalping trade, or what even constitutes a scalping trade versus a swing trade or a longer term trade? Well, the answer to that is ideally in a perfect world, you probably really shouldn't be looking for, take profits any smaller than probably 15 pips, only because, you have to have some sort of, it's going to come into it in the risk management side of things as well, where you have to have at least a 1-to-1 risk reward ratio. Okay, so even though you're scalping, it doesn't mean that you should be, risking, 2 times what you're planning to make because you think that's what scalping is. Scalping still has a very, very solid rule if you want to be successful, that your take profit level has to be the equal, if not greater than your stop loss level. Now, for those of us who have been doing trading for quite some time, anything smaller than a 15 pip stop loss often gets hit prematurely.
Oh yeah.
Everybody knows that.
Especially opens of sessions, guys.
Absolutely. Yeah. If you're trading in an open of a session, or even, prior to some important news, 15 pips is really a nothing movement. So in a perfect world, you're probably wanting a stop loss of at least 15 pips, which means that, you want a 15 pip take profit at the very, very least. Now, there's nothing wrong with 1-to-1 trades when you are scalping. We're not going to be too greedy with what we're looking for. But I always go by the rule that, generally when you are scalping, to really define what scalping is, it wouldn't probably be more than a 3-to-1 trade as a rule. You're usually going to be a 1-to-1, a 2-to-1, or a 3-to-1. So probably
similar to that euro.
Yeah, exactly right. So that's going to take you, somewhere up to the 45, 50 pips. If you can get 50 pips out of a scalp, you've done well.
Mm-hmm.
If it's going over 50 pips, then you're really sort of moving into a swing trade, because the market just hasn't got that much movement in it most of the time in the main pairs, where it's going to move in a scalping fashion 50 pips at a time and actually continue on with it. So it's not realistic to be having a 15 pip stop loss and 100 pip take profit on a scalping trade. You must have more evidence if you're going to be doing that.
Yeah, so this is basically what you could do, of course, if that market did break. So let's just quickly build a strategy based around what we saw in that euro, and then we'll get back into the charts. So we could see there that we had the stochastic indicator. So we had the stochastic in the overbought or oversold, depending on whether it's above or below. And then we had the support resistance, which was our channel. Whenever it hit the top, which is our resistance, we were interested in potentially taking the short position. And whenever it was going to hit the support, which is the bottom, we were interested in the buy position. We can also use trend lines. We didn't have a trend line there, but we can use trend lines. We can use Bollinger Bands, and we can use the MACD indicator as well. So with points-based systems or a rules-based system, because we need more than one thing to be successful at trading, we need more than one reason to be in a trade. Usually I like to give points to the reasons I want to get in a trade, and then you set a minimum amount of points that you need to place those trades. And that keeps you consistent. It makes it treat like a business. You treat trading like a business. And only really when I think we started treating trading like a business and really put it down to, is this a points-based approach? Does it work or does it not? Did we get the consistency in our trading? I cannot stress it enough. I've made a mistake. I've made some mistakes.
We've made these mistakes, so we're here to show you how to avoid these same mistakes that we made many years ago. Now, the thing with the points-based system is, although you are building a case for the trade, it's forcing you to actually look at the bigger picture. Even though you are scalping, you still need to take a very good look at what is happening around you. And by using these different indicators and different methods like support and resistance and trend lines and MACD, like I mentioned before, you're giving yourself the opportunity to put you're putting your shoe or someone else's shoe on your foot. That makes no sense at all, but don't worry. You're basically looking at through the eyes of other people as well. Okay, so you've got stochastic traders who are going to trade every overbought and every oversold zone in the channel. You're going to have support and resistance traders who just trade all support long and all resistance short. You're going to have trend line based traders who are trading every touch of a trend line in the direction that it's supporting. So when this all comes together, you're basically getting the momentum of the market in your favor, because you've got many different people trading different things, but essentially looking for the same result. Now, a lot of people say, you shouldn't trade with the herd and you should do the opposite of what the herd is doing. Now, that couldn't be actually further from the truth. What that should be specific to is actually having a reason to trade in a particular direction and hoping that the herd is actually going in your direction. Because if the herd is going in your direction and you've got a different reason to go in that direction, that makes your trade even stronger. What we don't want to see people do is trading in the direction of the herd for the sake of trading in the direction of the herd and not really having a specific technical reason.
I can't give a better example than cryptocurrencies recently to that. If you were trading to the short side, obviously up until a few months ago, if you were trading back end of last year against the market and against the herd, oh man, it would not have been good. Yeah. So following that trend, but you don't just follow it for the sake of following it. So even there, you will see things like, there's no coincidence. The Bitcoin hit $20,000 all of a sudden, and it hit around there, and that's a bit of a psychological number. And then, of course, it shorts off that point and never gets back to it. So there are these things where you need to be mindful of what's going on, but you still want to be following the general overall
You want
trends.
the people and you want the momentum always in your favor. If you're running with the bulls in Spain, you're not going against the bulls, you're running with them. and trading is exactly the same. You don't want to be putting yourself in the way of a very strong moving market. Okay, so that's why having a points-based system, giving yourself the opportunity to see what everybody else is doing and really opening your eyes to the potential that there could be reasons that you shouldn't be entering the trade, because really the points-based system is actually to keep you out of trouble more than actually get you in it. So getting into a trade is the easy part. Working out where there's trouble ahead can be the hard part, and that's why the rules-based system will help you do that.
Always easy to press the button, really hard to figure out where you're going to take your profit, where you're going to place your stop loss, that kind of thing. So let's now take another look at the markets and specifically now target a different currency. So we'll take a look at the Australian dollar. Now we're on the 15-minute chart again here. Nice particular time frame for us to take a look at when looking at scalps. And Tyron and I were discussing this before. We actually just jumped on a half an hour. And what we can see here is that we can see there's been a bit of a trend line forming on the bottom end here on this particular currency. So we'll jump back in that 15 minutes and you can see every time it's coming down to this point, it's finding some form of support and then it's bouncing off that. So if we now add some indicators, let's add our Bollinger Bands. Let's add our stochastic. And of course, you can save these as a template. I highly suggest you do that rather than do this every time. And we can talk about this particular market. So Tyron, do you want to have a bit of a discussion about this trendline market?
Sure. So straight away, we've identified that there's a trend line there, potentially giving some support, although ascending to the 15-minute chart over the last, basically a week. We're talking about a 4 or 5 day period here that we're analyzing. But let's go back to our rules-based system for a second and start picking out basically where we can add 25 points to every long that we're doing. Obviously, with a trend line that's going up, we're going to treat it as support. So we're looking to take a long position here. So we're looking for evidence that basically tells us that, yeah, there is a good chance that this market is going up. So let's begin. We can straight away give 25 points to the trend line itself, because it's one of the first things that we've actually noticed about where we are at market-wise. Do we have any indicators in our favor? Okay, so we can't really gain anything from the stochastic here because it's not really in the oversold just yet. So we'll dismiss that one and say that's not giving us any points. The one closer to home is obviously the Bollinger Band. So we've got a 2 standard deviation Bollinger Band, which at the point where price was just below the trend line, you can see did break through at the bottom of the Bollinger Band. Now remember, that the Bollinger Band doesn't have to be breached to actually be useful. Just being in the zone is basically telling us that it's 2 standard deviations away from the mean. So even in the vicinity is enough to say the Bollinger Band is useful to what we're trying to achieve here. We wouldn't want this upper band being here because that would obviously entail a short position. So we're at the lower band, so we can give the Bollinger Bands a 25-point tick. Okay, so we've got the MACD. Like I said before, that uses moving averages. So what we can see here is the MACD, I'll just put the crosshair on it. We can see that the MACD peak or trough, I should say, for the lower is quite a bit higher than it was previously, which is telling us that the fast moving average is actually getting closer to the slower moving average from below. So when the histogram is actually below the 0 line, the fast moving average is actually below the slow moving average. And when it's above the 0 line, the fast moving average being the 12 is actually above the 26. So we can see here that the 12, although it is still below the 26, is a lot closer than it was a lot closer here than it was at this point here, which is telling us that the momentum is starting to return to the longer move on this particular pair. So we can give a MACD divergence a tick. So we've got 25 points on the MACD. We've got 25 points for the trend line. We've got 25 points for the Bollinger Band, which has given us the 75 points required to take this trade, fairly seriously. Okay, so
I need to stress it's not, look, obviously we're looking for live market examples right now. This is not what we call a class AA trade. Like, it's not perfect, but it does show you how we put those rules together to place the trades. And then, of course, what we also want to do is we want to work out, well, where's our stop loss going to need to be for us to be, giving it a little bit of room here, and where's our take profit potential? So our take profit potential, I think, is, very seriously up here because that was the last real peak. So 20 pips, so scalping kind of trade. And our stop loss, if you really want to be conservative, would be under this last swing, or we could just place it once we're out of trouble, give it like a generic stop loss of just 20 to start off with, and then move the stop loss up behind this particular candle here. So we can do that, and we can build our scalping strategy and build our stop loss rules around the way that we see the market moving. So at the start here, I don't think we've got a clear stop loss except for this one, which might be too big. Let's have a look here. Oh, it's 15. Okay, we could definitely go below here. So we're going to go below here with our stop loss. We've got a 20 pip take profit, 20 pip kind of stop. That's the kind of thing we're looking for. It is scalping. 1-to-1's okay as long as we're statistically more correct than not correct. So this is just an example of seeing a really good trend line. The trend line is definitely incredibly solid, and then we need to build a strategy around that. So I just want to show you down here, you can see that when you've got that stochastic super oversold, you've got that trend line, you've got that breach here of the Bollinger. It did really move quite heavily in your favor. Obviously, that was just before we got the trend line. Really, that was probably really the proof of the trend line. So here we'd be looking for the opportunity. Maybe it wasn't there for our points-based system, but if we have 3 to 5 currencies, they are going to show up. And when they show up, you know, if you're getting a 30 or 40 pip to a 20 pip stop loss, you're doing very well. That could be 1% to 2%. And of course, we know that 1% to 2% done, 50 times is not that bad.
That's right. That's right. Now, and the other thing you have to be mindful of when you are scalping, and this is very, very important, is that you've got to be mindful that we're on a 15-minute chart. Okay, so all of these signals that we are seeing are representing the movement that we expect a 15-minute chart to provide. So this trend line, is not probably, it's more than likely not going to reverse, this particular pair and send it to 90. Okay.
Yeah. Be realistic, guys.
You've got to be very, very realistic in your expectations of a scalping trade. It's very, very possible that you're going to get 20 pips fairly quickly. So in these sorts of situations, when you are scalping, it is very important to have your take profit and your stop loss clearly defined before you enter the trade, because the trade can happen very, very quickly. So you don't want to be thinking about it, after you've placed it, where am I going to put my stop loss, or where am I going to put your take profit? Because in the blink of an eye, the market could potentially move against you or for you, and you just won't have a plan in place to take advantage of it. So be very, very clear in your head where your stop loss and take profit are going to be prior to placing a trade. It's vital in a scalping strategy.
I just wanted to discuss this one before we talk about risk management, and that is the US dollar yen. So you can see here, range bound market, very similar to what we saw on the euro, but this time it's on the daily, and you can see the break that happened about a week and a bit ago. Now, what this can do is, because we're using multi-timeframe analysis, it can give us the bias towards potentially the short side here on the US dollar yen, and we can be looking for the scalping strategies on the shorter timeframes. So on the shorter time frame, maybe every time we find a short position in the scalping strategy, it probably is going to have more aggression in that direction. So just always keep that in mind. If you ever see that happening on the bigger time frame and you have a trade in, you could potentially use it in the scalping strategy.
Just to build on what Thomas was talking about there, we have got the break of this sideways market, and now the market has potentially gone up and retested the break, which is a very, very common occurrence in this situation. So by going back to the smaller time frames, we're going to be very biased to the short. And when we do go back to a 15-minute chart, we can see very clearly here all the things that we just talked about. We've got the resistance, from basically on a 15-minute chart, just like we saw before. We've got the falling of the moving averages. So we know that the moving averages are getting closer and closer together, meaning that the upward movement in moving averages is starting to lose steam. So straight away, without even putting any other indicators on, we've already got 50 points, and we haven't even placed a stochastic or a Bollinger Band on this chart. So you can see how easy it is to actually isolate a trade very, very quickly, but also incorporating multi-timeframe analysis. And multi-timeframe analysis does count as 25 points.
All right, so let's now, before we jump into the Q&A, so if you have any questions, please put them in the chat now. But let's talk about risk management. So we are going to go over the age-old thing, which is risk between 1% to 2% of your account. Obviously, once you've proven a rules-based strategy, though, what you can do is, once you know your statistics, you've been doing it for 6 to 8 months successfully, you know what your drawdowns are going to look like, what your risks are. So you potentially can up your trading risk slightly and therefore make a much better return. So it is based on when you build a business around trading, you can get better returns. And you're in it for the long haul with trading. You're in it for a lot of years. None of these systems are going anywhere, not even to computers or anything like that. So you really need to get that kind of business mentality in trading. The other thing I want to bring up was do not basket trade. We've seen a lot of people go down from this, unfortunately. So what I mean by that is if you're trading multiple JPY pairs together and you're going in the same direction, what that means is your risk is automatically larger. If you're trading Euro yen, pound yen, US dollar yen, odd yen all long, and you've got 1% risk per trade and you go, I've got 1% risk per trade, what do you think is going to happen if you're all long and then the yen starts, it all shorts against you?
What you're going to find is, although they do move independently and not every move is identical, if there's an adverse movement against the yen, you're going to be stopped out on every trade that you've placed. So you're really effectively trading a very, very strong bias of potentially a yen long or a yen short, even though you've broken down your risk, 1 or 2% per trade. It can be very, very costly, especially around news events where the momentum of the market can shift significantly. So you've got to be very, very mindful that you diversify your trades. And this is what we were talking about earlier. When you're managing your trades that are open, it's very important to make sure that you're not basketing too many trades together, so you're not actually increasing your risk sharply, because that's what you are doing by trading too many of the same pair in the same direction.
Last two things, just want to say, obviously follow your built-in strategy. And remember, if you do take a 50% loss, that requires 100% gain to get back to the break even. So we really want to, and that's hard psychologically. And you'll hear a lot of people, whenever you see the standard webinars talking about risk management, they'll always be talking more about psychology and the fact that you are your own worst enemy and all these kind of things. And I'll always remember somebody where they got basically like a tissue and they drew a big circle and they drew 3 bits of a pie and they said, this one's your trading system, this one is your risk management, and this one, which is the biggest bit, was, guess what? Psychology. And I tend to agree with everybody on that one. You are your own worst enemy. So you really want to do everything in your power to make sure that you are not risking too much. So your psychology is really good and you follow your system and you follow your business strategy. So that brings us to, I guess, the end of the webinar. We hope you really enjoyed it. I think we went through a lot of information there. So we'll take it over to Josh now and see if he has any questions, if anyone's asked anything.
We do have one question here, and it was in regards to the last chart you were on. Someone is asking, what is the value of your blue moving average you had on there?
The value of the blue moving average that we've got here. Okay, let me just have a look here. It's a 200 that we've got on there. Now, one of the reasons we actually really like 200s on daily, I think that's in another one of the webinars we discussed, and we will discuss this again when we talk about trend-based strategies, but we're big on 200 moving average. Tyron, do you want to tell everyone why?
Sure. The 200 moving average is it's generally regarded as one of the best trend direction moving averages, especially on the daily charts, because it does represent a significant portion of the year. So in the stock market world, a 200, basically a market trading below its 200 moving average is considered in a downward trend, no matter where it is placed in the economic cycle. And trading above the 200 moving average, it's considered an upward trend. So following on from that, the currency markets seem to adopt the same kind of strategy. And you'll find, particularly in the bigger time frames, when the price does approach the 200, it is always respected. So even here, like we can see on the daily, we can see how many times it did actually get respected when it touched it. It very rarely breaks through and doesn't come back to at least touch it. So you can see right through, this area here, it just could not break through. And then when it did break through, it came back, hung around, went to tested it again. It came through. We had one big break here, but obviously that was a very big economic news shift.
And it changed the trend.
It completely changed the trend. But then when price did come down and look at the 200 again, it found support. Okay, so it is also important to remember, I'm not sure if a lot of people know this, but when the 200 moving averages change between charts, it does adjust to the amount of candles there are on that chart. So on this particular one, we're looking at the 200 daily moving average. So it's deriving its current position from the last 200 daily candles. But when we move it to a 15-minute chart, that 200 automatically adjusts to the last 200 15-minute candles. Okay, so it's very important to remember that the 200 moving averages, although a lot of people call them daily moving averages, they are actually period moving averages. So they always adjust to the chart that you're on.
But we really like the 200 on the daily for just kind of like a quick cheat sheet for figuring out where the trend's up or down. Yes, you can see it in the charts, but the 200 is often very, very good for giving you a quick bias. All right, well, that was the only one, Josh?
Actually, we've got a couple more that have come through. This one here, do you use RSI in scalping?
RSI, Ty, here we go. We were talking about this before.
Okay, look, RSI is a very powerful indicator, and it is widely used, but we choose not to use it in scalping methods because we find that the stochastic often gives a very similar signal to what the RSI does, but the stochastic is a little bit more clear in the signals that it offers. So traditionally speaking, when you're talking about an RSI indicator, under 40 and, well, usually 70 and 30 the standard settings. I like to move them to 60-40 if we're sort of talking a bigger time frame. But I always find that they're giving very similar information. It's quite rare actually that the RSI won't agree with the stochastic, or the stochastic won't agree with the RSI. So by using them together in a points-based system, it's almost like it's cheating because you're basically doubling up on essentially what is a very, very similar signal. And that is because they're deriving their signals, although one's deriving it from the high and the low being the stochastic, and the RSI is using the 14 periods of momentum, basically, because the RSI measures the amount of up periods and down periods over a defined point in time. So it's using the last 14 days. It measures the last 14 days of ups and the last 14 days of downs. But the stochastics measures the last 14 days of highs and lows. Now, the two do correlate a little bit. Now, although they're not exact, they are very, very similar. So I find that one or the other is the best to apply a points-based system to. But stochastic, especially in a range-bound market, we find is far more effective to give us the signals that we're looking for.
Yeah, and we don't want to be cheating in our rules-based system.
No.
And last one, Josh?
Yep, we've got the last one here, and it is, if you look at the daily chart and it shows an uptrend, and then look at the hourly chart and it shows a retracement, how do you decide to?
Yeah, so, well, you are scalping, so you shouldn't, if you are looking at a daily chart and you're seeing the uptrend, like kind of like that euro, then you are a bit more biased towards the uptrend. You will find that the longs or the buys are going to statistically over time work out better for you. That being said, you're scalping. So you cannot change. You still need to take, if you're getting a short signal, you still need to take it because that could be the change of the trend or change of at least that temporary trend or the retracement on that smaller time frame. So while we would be biased more towards the long side, even something you can build into strategies is you'll find that if you're doing a risk-based approach, sometimes you can actually put 1.25% risk on the ones that are with the daily trend and 1% risk on the ones that are against the daily trend, and you might find your statistics are actually better. So just little things like that, you can tweak your system over time and you'll find quite profitable.
What you'll also find in that instance is if you do have the daily in your favor, so if the daily trend is up and you are scalping basically long, you are going to get a little bit more power out of that movement like Thomas alluded to. So if you are your risk reward is going to be better in those type of trades. And again, you can build a point system into that where you could say maybe not giving it a whole 25, because realistically, you are scalping, you are still scalping, and there is a very big difference between a 15-minute chart and a daily chart in regard to trends. But what we've given you is basically a template of how to build a system. It's really up to you and your trading style and how you can actually add things to tweak it and maybe build it up to a 100-point system and maybe give some things smaller or larger values. It really comes down to the pairs that you're trading and the timeframes that you're trading. So I encourage everybody to really have a good look at it and just use it as a bit of a base and build it, because everybody, like the RSI question earlier, people do have their favorite indicator. So it's always good to use.
And we're not saying anyone's wrong or right.
Absolutely
it's just
not.
Ones that we know we've used.
These are the ones that we like to use, but it doesn't necessarily mean they're the best. It just means they work best for the situations that we're looking for. So yeah, I encourage people to really explore it. But if you're going to use an indicator, understand why and how it works.
Excellent. Well, thank you very much, everybody, for joining tonight. And we really enjoyed it, and we're going to really enjoy the next couple of weeks when we're doing the Learn It Live series. I think we've got some really good stuff for you guys. So if you enjoyed tonight, I definitely suggest you attend that. So from FX Evolution and Tom and Tyrone, we'll see you next time.
Have a great night, guys, and thank you.
Thank you.